Hey there, I'm estate planning attorney Paul Rabalais, and in this video we're going to talk about whether to keep or donate appreciated assets. All right, so some people get to a point during their lifetime where they've accumulated some assets, they have some assets that they know they're not going to need to consume, and they really want to pass those assets along to the next generation or two, and they've got to make a decision whether they should keep those assets in their name or whether they should go ahead and give away those assets to the next generation before they pass away. So that's what we're going to look at. And when you do look at that, you have to look at both the gift and estate tax rules, you have to look at the capital gains tax rules, you have to look at control issues, and you have to look at the income tax rules. So let me put it as an example. Let's say mom and dad are 72 years old and they have let's say about $4 million in appreciated stock. Let's call it publicly traded stock. It's very liquid. There's no question about the value of the stock. It's worth $4 million. And mom's parents gave that stock to mom and dad many years ago. And so the basis in the stock, because mom's parents gave it to mom and dad, the basis in the stock is the value of the stock when mom's parents acquired it, perhaps as many as 50 years ago. So let's call the basis zero, although it's not zero, it may be close to zero. But now it's grown and it's worth $4 million in value. Mom and dad have 3 children, they have 9 grandchildren, everybody's an adult, we don't have any minor kid issues to deal with. And mom and dad's total estate, including the $4 million of highly appreciated stock, mom and dad have another $6 million of assets. So their total estate right now is right at $10 million. The $4 million of appreciated stock, plus the other stuff that they have, IRAs, investments, homes, etc. So they're trying to figure out, we really want to keep this stock in the family. We're worried about taxes. We'd like to stay in control. Our kids are all good and in a good spot. Even our grandkids are in a good spot. What do we do? Should we keep it or should we go ahead and give it to them during their lifetime? Very good question, by the way. I don't know if there's a slam dunk answer. Let's look at the different options. So the first option is mom and dad keep it. They keep it in their name and they just hold on to it, and in their will or in their revocable living trust, they leave it to their 3 kids equally. Why would they keep it? Well, they would keep it for one reason is because they would want their children to benefit from the step up in basis that would occur if this stock was in mom and dad's estate when mom and dad passed away. So under the keep it scenario, mom and dad either just keep that stock in their name or they keep it in their revocable living trust. Those assets will be included in the estate of mom and dad, but the benefit of that is the kids will get a step up in basis. So the basis in that stock will adjust from zero or close to zero to whatever the value is on the date mom and dad die. Let's say 4 million, might be more than that. And so if the kids sell the stock after inheriting it from mom and dad, kids will be in a great spot. They'll pay little or no capital gains tax because they benefited from the step up in basis. Another reason mom and dad may want to keep it is because they'd like to stay in control. They trust their kids are in a good spot, their grandkids are in a good spot. But you never know. If mom and dad give that stock to the kids, and then, who knows what might happen, mom and dad lose control. So mom and dad like the idea of staying in control of the stock. That might be another reason they keep it. Now, the next thing we have to look at regarding keeping it is the estate tax consequences. And this is where there's a lot of unknowns. So right now in 2021, mom and dad each have an $11.7 million estate tax exemption. And with the marital deduction and portability and all these estate tax rules that benefit married couples, mom and dad can shield $23.4 million from the estate tax. So right now, the mom and dad are safe holding on to that stock. In fact, that's if the estate tax laws don't change and mom and dad's total exemptions are $23.4 million or more, then it's a slam dunk no-brainer. Keep the stock, mom and dad. Keep the stock. It's in their estate, but no big deal. Their estate, which is now $10 million between the two of them, can be up to $23.4 million. So even if mom and dad keep the stock and include it as part of their estate when they die, there's still none of the 40% estate tax because the estate didn't exceed those exemptions, which are high right now, and the kids would benefit from the step up in basis. So that's the double best thing that can happen: step up in basis and no estate tax. However, our estate tax is going to change. Mom and dad know that they're likely to live a few more years, and we know right now, things could change tomorrow. But right now, if there's no legislation changes, the estate tax exemption is going to roll back on January 1st, 2026 to $5 million adjusted for inflation for each estate, probably somewhere around $6 million. Under that scenario, each spouse has an exemption. $12 million would be exempt. They have a $10 million estate now. It has been appreciating significantly over the years. It's likely going to appreciate some more. So now the decision gets a little tougher. Do we keep it in our estate to get the step up in basis when we die? Or do we try to get it out of our estate under some scenarios that I'll talk about here in a minute, because we fear that there'll be a 40 or maybe a 50 or 55% estate tax if we keep it in our estate and our estate grows and the estate tax laws are such that there'd be estate tax due when we pass away. So that gets tough. Now, some people out there believe that the estate tax exemption is going to be reduced significantly, maybe down to $3 million or $3.5 million. That's when mom and dad are kind of going to get screwed. So the holding on to it to get the step up in basis may be is to get the step up in basis, but have it be subject to a 40 or 50% estate tax. That's no good. So this whole, what's the estate tax going to be when mom and dad die? That's the big question, and that's the unknown. So that plays a factor into whether mom and dad keep it. And they want to keep it because they want to stay in control and they want the kids to get the step up in basis. But the capital gains tax rate, the federal rate's around 20%. The federal estate tax rate is right now around at 40%. So may not do much good to keep it to get the step up in basis when it would be subject to a 40% estate tax if they keep it in their estate. So that's the dilemma. All right, so that's some of the keep it issues. Now let's look at some of the giveaway issues. And there's a couple of different ways they can kind of quote unquote give it away. The first way they could give it away is by using up their annual exclusions, their gift tax annual exclusions every year. I said they have 3 kids. I said they have 9 grandkids. Everybody's an adult. Mom and dad can each give $15,000 to as many people as they want to every year. They have 12 descendants. So mom and dad, between the two of them, can give $30,000 to each descendant, give it to whoever they want to, but they want to give it to their descendants. So that means mom and dad can transfer $360,000 of value each year by using their present interest annual exclusions, which doesn't use any of that gift and estate tax $11.7 million exemption or whatever that might be. So that sounds pretty good, but it'll take a long time at $360,000 a year to transfer $4 million of stock. You may think that's going to take about 12 years. It actually may take more than that, because over time that stock will likely appreciate in value. So it may take much more than 12 years. Mom and dad are 72 right now. So it'll take it a long time for them to give it away. And if they give it away, again, the kids and grandkids get the carryover basis. So that's not great. Sure, they got the assets out of the estate without using any of their estate tax exclusion amounts. But by giving it away during their lifetime, the kids get the carryover basis, which is whatever mom and dad's basis was, which is essentially zero in the $4 million of stock. So that's just a chance that mom and dad would take to, yes, the kids and grandkids will incur a hefty 20% tax on that sale because the kids and grandkids got the carryover basis. But at least that stock will be avoiding what could potentially be a 40% estate tax on the value of the stock on the date mom and dad died. So that's one way to give it away, is to use mom and dad's annual exclusion, 12 descendants, $30,000 a year, $360,000 of value transferred out of mom and dad's estate every year without using the estate and gift tax exemptions. Not a bad plan. And then the other option of giving it away is just giving it away all at once. They're like, all right, kids, y'all take the stock right now. And they might do that if they feel like the stock is going to significantly increase in value in the coming years, and they want to freeze that value of the stock for purposes of gift and estate tax. Because if they keep that in the estate and the $4 million grows to $15 million before they die, then now they've got $15 million in their estate. That could be trouble. So the idea is mom and dad transfer all of that $4 million of stock to the kids. Sure, they'll use a little bit of annual exclusion gifts to do that, but essentially mom and dad will each have used roughly $2 million of their gift and estate tax exclusion amounts. But the benefit of that is if after the donation is made, that stock takes off, then all that future appreciation escapes the gift and estate tax. So that's the idea on giving it away all at once. And yes, when you give it away all at once, it could be an outright gift to the kids. It could be a gift in trust for the kids. And so those are some of the control issues. But the capital gains tax and the estate tax consequences are the same, whether you make an outright gift where the recipient just owns it in their name, or whether it's put into some type of irrevocable trust for the child or for the grandchild for some benefit that comes with having it in an irrevocable trust. All right, so you got three. What's the best one? That's a tough one. Do you keep it? Let the kids get the step up in basis, which is awesome. By keeping it, mom and dad stay in control, which is awesome. But by keeping it, number one, the stock could appreciate in value, and number two, the estate tax exclusion amounts will be reduced in upcoming years, so you may be subjecting that stock to a 40% federal estate tax. Do you give it away? Well, maybe you do give it away using your mom and dad $30,000 annual exclusion gifts, but anything mom and dad give away during their lifetime, the recipient gets the carryover basis, so that's not good from a capital gains tax standpoint, but at least you're getting it out of the estate for potential estate tax purposes when mom and dad die. And then the other option is give it all away at once to avoid that future appreciation from being subject to the gift and estate tax in the future. What's the best? Who knows? I would feel like in most circumstances, mom and dad may hold on to that stock for now because that's the only option that could be the perfect scenario. Step up in basis, mom and dad keep control, and avoid estate tax because the current estate tax exemptions, $23.7 million, the estate, even with the stock, doesn't reach that figure. But estate tax is going to change. So there you go. Your guess is as good as mine. Feel free to comment below. We'd love to see your likes, your comments, your subscribes. And you know what? We'll see you next time.